A very good afternoon to everyone who has joined us today as part of the informational webinars launched by India Juris. We will commence today's discussion and deliberation on our topic for the day in a few moments, which is going to take 10-15 seconds to allow more participants to join. Welcome back, everyone. Good afternoon once again. I, Ananya Rastogi, on behalf of India Juris, welcome our esteemed speakers and participants to our webinar on today's topic of discussion, which is setting up and structuring of funds in GIFT City, taxation and legal developments. India Juris is a leading law firm providing full legal service pan-India as well as the global market. It has also been ranked #1 in private equity and venture capital transactions by the Venture Intelligence Report. We have offices in Delhi, Gurgaon, Mumbai, Bangalore, and the GIFT City. To deliberate and enlighten us on today's topic, we are joined with Mr. Ashutosh Sharma, Chief General Manager at IFSCA, Mr. Rajesh Gandhi, Partner at Deloitte India, and Mr. Samir Rastogi, Managing Partner of India Juris. We are also joined with participants from a diverse range of sectors like funds, consultants, advisors, even students and academicians. I would now like to take a moment to introduce our esteemed speakers. Firstly, we have Mr. Ashutosh Sharma. He is the Chief General Manager Development at IFSCA. He's a senior business leader with over 2 decades of diversified experience in the financial services sector. It spans across policy making, strategy, business development, and program management. I cordially welcome Mr. Ashutosh Sharma. Next, we have with us Mr. Rajesh Gandhi. He's a partner in the tax practice of Deloitte India with experience in diversified sectors, especially in financial services, technology, media and telecommunications, and customer business. Mr. Gandhi has more than 23 years of experience in domestic and international tax, SEBI, and exchange control regulations. I warmly welcome Mr. Rajesh Gandhi on behalf of India Juris. Last but not the least, we have with us Mr. Samir Rastogi, Managing Partner at India Juris, with more than 20 years of experience in advising clients globally in various sectors like private equity and venture capital, and many more. I welcome Mr. Samir Rastogi.
Thank you. Thank you, Ananya. So, thank you, Ananya, for this good introduction. And friends, this is another series of webinar by us on GIFT City, and we are trying to spread as much as information possible. So today we have very eminent and good speakers with us to give you first-hand information and more information about GIFT City. So Ashutosh, welcome. Ashutosh Sharma is here. He is CGM and he has a huge contribution in. He has contributed a lot in the development of GIFT City, what IFSC is doing, and we keep interacting with him on various forums. He has been very cooperative and very knowledgeable person, and you have already seen his profile during in starting. So first of all, in this webinar, we'll have a insight from Mr. Ashutosh Sharma on GIFT City, what is happening, development of that, so that the participants, every time new participants are joining, they would have more information about GIFT City, how the things are developing. Thereafter, I will be putting up a presentation on setting up funds, and then followed by Mr. Rajesh Gandhi, he is partner in Deloitte, and on the taxation aspects of the fund. And lastly, we will have a Q&A session. So I invite Ashutoshji. Ashutoshji, please welcome and would like you to please give insight to the audience, the participants about the GIFT City and the system developing over there. Over to Ashutoshji.
Thanks a lot, Samirji. I think very relevant, and I congratulate India Juris to organize these webinars continuously to educate the ecosystem. I think the way GIFT FSC has been growing, it is, I always say that GIFT FSC is going to touch probably every individual and every business segment in India in times to come. I think GIFT FSC now, it's while it started more than a decade back, 2015 is when IFSC was formed. That IFSC which came in 2020, and that is the time probably from which GIFT FSC is seeing the acceleration. I think few areas which I want to highlight, how we are thinking as a regulator, how and where we have reached so far, and some of the statistics where we stand today, and way forward. What we are trying to do at IFSCA, and how Government of India is thinking about, we are saying that India, despite being among the top 5 nations globally when it comes to GDP on parity terms, still it stands without a global financial center before GIFT FSC came. Also, if you think of a country of this size globally, you will not find a country growing without an access to the capital. And when we think, we should think about not India of the past. And when I say India of the past, many of us probably who have seen the 90s and 2000s in India, we have seen how capital formation has happened in last 2.5 decades in India. And at the same time, we have seen how India as a country has grown. We have seen how our counterparts like China, they have grown at almost double-digit, high single-digit numbers, and what they have achieved in terms of growth. If you think of how government is thinking about it, government is saying that, okay, by 2047, we want to become a developed nation. And if we try to split it and what it means and how GIFT FSC figures into that, we should say that, okay, what does a developed nation mean? How do you measure a developed nation? I think one of the good parameter could be a per capita income. If we want to become a developed nation, we probably need to grow from current per capita income, which is running into 2,000 plus, to maybe around 20,000 plus. We need to go 10x on the per capita income. Certainly, if you want to increase per capita income, you have to create those kind of infrastructure, those kind of facility, that kind of business opportunities in the country, so that that capital can contribute to growth of what we call in Hindi Janmanas, common individual. This is the lakshya, this is the ambition of country, this is the ambition of which is we proudly as an Indian we should carry on us. This is where the country is going to be. Now you think about a nation, you think about a nation which has a college, people who are joining the college, and the rate which is less than 20%. And then you think of a developed nation like USA, where this percentage is more than 60%. And now think about when 2047, if India is going to be a country with that kind of a penetration in higher education. And now if you combine the two sides, the per capita income projections, the education penetration, and the kind of opportunities that are going to come, I think future is very bright for India. However, there is one key raw material that will feed into all these future ambitions. And where, for example, if you think of India had 75 airports, now India has 149 airports. India aims to put another 75 airports now in place. We are connecting small cities under RCS scheme, Udan scheme. If you have to connect all of these dots together to build the airport, we need capital. To build the shipping ports, we need capital. The roads require capital. Even the business corporate parks, which require capital, as you know, InvITs and REITs are very common in India. They require capital. Now, capital can come from domestic, or capital can come from offshore or global investors. And if you think of some of the numbers, if you think in India, one industry which has grown significantly in last 11 to 12 years is AIF industry, like fund business. It has grown significantly from just 300 crore kind of a capital to running to several lakh crores of capital. All these capital that is coming into India, this AIF capital that came into India itself, it has around 66% of these investors are foreign investors in the AIF in India. This is the contribution, and they have changed the game completely in startup ecosystem and manufacturing ecosystem in India. In real estate also, they have changed the game completely. So this is the impact of capital. So at IFSC, what we aim to do, we want to bring entire offshore capital into IFSC, and we want to act IFSC to act, GIFT IFSC to act as a soft lending base for global capital into domestic market. This is one area we are aiming for. For this, second, we are saying that Indian investment also want to go outside. For example, Indian companies want to go global. We want to make GIFT FSC as a hub for that as well, so that Indian companies can become global companies, globally competitive companies. And third element we are looking at is certainly the innovation. We are saying that we need to facilitate a lot of innovation in IFSC. We always say that it's not only technology, it's regulatory also, but we are looking at both sides of innovation. Now, I try to then how we are going about it, we are looking at regulations. We came out with banking regulation, capital market regulations. We came out with funds, AIF regulation. And I think both Mr. Gandhi and Mr. Samir are going to talk detail about it. But when we, very high level, we said that, okay, how the regulation are structured in domestic, how regulations are structured offshore, what is the most optimal way from business perspective to structure the regulations so that the investments can come in a most efficient, friction-free format. Should we regulate the funds? Should we regulate the fund management entity? So we decided to regulate the fund management entity instead of funds. That is the approach we took. Similarly, when we look at banks, we benchmark the regulation globally, and we shifted away from the domestic regulations, which are more prescriptive, to principle-based regulations in banking ecosystem, something that you see in Singapore and other jurisdictions. And similarly, we approach for all other different vertical, be it insurance, be it other. And then we looked at some 2 or 3 other dimensions. One dimension we looked at, if you have to bring all this ecosystem, we also need to bring the ancillary ecosystem. The people, the businesses which are going to enable other businesses, the law firms, the accounting firms, the tax firms. And I think India Juris is one of our ancillary company already in IFSC. They've applied here. They're the law firm established in GIFT IFSC. Similarly, all the big fours are planning to be in IFSC as tax advisory entities, which are providing services outside India. So we brought out these ecosystems, and then we looked at some of the niche. We said that, okay, we want to bring the aviation, shipping, foreign universities. We brought various other ecosystems into GIFT IFSC. So we are looking at it a very holistic perspective. We are saying that, okay, we are a unified regulator. We want to bring the insurance, capital market, banking, funds, as well as beyond this, what India has lost out outside, whether it's aviation, whether it's shipping. Right now, we are thinking in new dimension where we are saying that, and this has been how our psychology works, how we approach things. And I'm encouraging all of you to come back to us if you have some ideas around it. But for example, a lot of Indian companies have gone outside India, Singapore, Dubai to do the commodity trading. So we are conceptualizing, should we look at that business also, while it is not a financial business like universities, which we have enabled, but should we enable that into GIFT IFSC? It's not a straight line answer for us, but certainly we are thinking along these lines. So where do we stand today? We now have around more than 650 licenses, authorization, registration have been issued in period of last 3.5 years due to various enablers. Among these, you have, I will talk about the enablers that we have done, but you will have more than 27 banks. Yesterday is a big day for funds ecosystem in IFSC because we have hit a century. Now we have 100 FMEs, which are fund management entities, the fund managers in IFSC, and the 100th is a very, very big name. It's a large sovereign wealth fund, a sovereign fund, one of the largest globally, which is coming and establishing here. We have already achieved more than 110 funds earlier. So now both funds as well as FMEs, they are more than 100, and it's growing very, very fast. It's a very strong ecosystem where we are seeing interest from both debt structure are coming, hedge fund structures are coming. The angel funds have established here. Some of the PE firms have also come. Even some PMS service providers have also established. And some of these activities are getting complemented by our ancillary ecosystem and some of other licenses like distribution licenses, where capital market products can be distributed. So while funds are going to come, they're going to invest into India, they're trying to create units. And now the banks and the third parties, they are coming and setting up under the distribution license, they intend to distribute these units as well. So we have 27 funds, we have 100 FMEs, 100 plus funds, we have 3 exchanges, and we have around 50 plus ancillary companies here. And we already have 2 foreign universities as well, which are just a beginning. The university is a very new ecosystem here. There is one new area where we are touching right now. Commodity is still at very early stage, but this new area is, we are saying, can we also enable the accounting, bookkeeping kind of a business in GIFT FSC? And that also is work in progress as we speak today. It's at initial stage because we have got the approval that we have to do it. We have to now come out with the regulations in that. But all the businesses that we enable, I think, as I mentioned, when the applications come to us, we certainly keep in mind that are we onshoring the offshore, some business which has gone outside and we are bringing it back here, or are someone or industry prefers to bring something that is already domestic into GIFT FSC? We have a preference to the prior, which something has gone out and coming here. If someone wants to bring some business from domestic into IFSC, there's a view over it, but if there's a very strong rationale and it's going to contribute incrementally to the country, then that discussion can be done. But primary agenda is onshoring the offshore, whichever has gone out of India, we have to bring it back. But main area is why people are coming here, why funds are coming, why banks are coming, why different ecosystems are coming. And I'll leave details to Mr. Gandhi and Mr. Sameer, but I always say that there are 3 things which define a financial jurisdiction, due to which investors and intermediaries establish in a jurisdiction. One is it has to have the right regulations. And I think GIFT FSC as a FSC, we have been able to bring out very competitive regulatory framework. Some of these are work in progress, but they're very competitive. Second, you have to provide them ease of business. So when entities are coming here, when you think of funds, for example, investors, when they're investing into these funds, do they require PAN? They do not require PAN anymore. Tax holidays are available depending on categorization of funds. The tax holiday has been enabled there. For fund, third dimension is competitive structure. And when I say competitive structure, I think it has 2 dimensions. One is operating cost, and second is taxation. Wherever I think fund management entity, for example, if they establish an IFSC, there is a tax holiday on the business income for FMEs or for the fund managers. And depending on the category, which details you will go through, we have made the tax framework also competitive compared to other jurisdictions. The reason why people are coming, while we have provided all 3 elements, they may have a presence in some other jurisdictions as well, where tax framework might be competitive. But those investors, the global investors, when they are investing into the platform from Singapore, Mauritius, etc., they're investing through those vehicles, and those vehicles have to then invest into India, and they have to prove that they have to take those exemptions and the tax through double tax treaties, DTAs. Whereas in IFSC, all the tax holidays that have been provided, these tax holidays have been provided under solid regulatory or legal frameworks. Some of these are the key differentiations as we speak, and why investors are coming here. Especially if I speak about, when we speak about the, for example, banks, which are the core pillar of any ecosystem. You have banks coming from Europe, US, Middle East are also coming now, Japan, Australia, every nook and corner of the world. When you think about funds, Now we have funds we have FMEs, Indian fund managers, some foreign fund managers have also come. Now sovereign fund have also come. When you think of LPs, I think best of the LPs, you think about the teacher pension funds, you think about the Temasek, GACs, even IFC, the World Bank entity, all the strong LPs, they have invested through the fund structure in IFSC, which is a strong testament to the confidence shown by entire investment ecosystem. We are certainly strengthening it further, and some of the steps that we are taking towards this is also we are engaging with regulators of key financial jurisdictions under by signing MOUs with them and trying to see how we can further enable this ecosystem. With this, I will take a pause and I'll hand it back to Mr. Samir. Thank you. Over to you.
Thank you, Ashutosh. Definitely, you gave an updated version of what is happening in GIFT City, and I'm also updated on this. And it is great to know that more than 100 funds are there. A lot of banks have come in there. And one thing, because I know you have some meetings and some urgent meetings, you may have to leave when the time comes. But just for the audience, I'm taking few questions. So for GIFT City, there are two regulators, SEZ and IFSC, that they have to apply. So I was told that few days back, one combined single window has started. So is it in process or it has started working?
Yes, good point. I missed it as recent, but I forgot it's more operational. But yes, it has been implemented. And earlier people have to apply on SEZ and IFSC separately. Now those authority under SEZ, entities will still come under SEZ. Approval of that has shifted away from SEZ DC to IFSC. We have set up our team on this. Our first committee will be early next week. We already have more than 40 applications lined up there. So yes, we are working into this area. Thank you.
So now single window application has started coming in.
Yes, it has started coming.
Okay. So Ashutosh ji, so we'll proceed further, and if you have some meetings, so you may decide as you have the meetings or commitments. So
I'll stay back. I'll come back shortly.
So we will take more question and answer in the end of the session, because a lot of questions have come to us offline, and whatever the participant would be asking, so we'll be happy if you are there to respond. Thank you, friends. So now we had, what Ashutosh ji has told, that there are huge scope for the new funds, asset manager, fund management entities, even for the professionals like us, the law firms, the accounting firms. So huge clientele is waiting there, so we can think of the professionals if they are here, or the PMS they are here, they can think of setting up their entities in GIFT City. So friends, now we move on to the next. So next I'll be sharing my small presentation on setting up fund in GIFT City. And when we are talking about setting up fund in GIFT City, it is some part of this would apply to setting up entity in GIFT City, which was just I was discussing this. So let me share my presentation. So friends, we are on setting up fund in GIFT City, IFSC. So I'll just take you to the background, those who are new or who are just new to this particular subject. So the IFSCA is the regulator in GIFT City in IFSC. IFSC stands for International Financial Service Center, and IFSCA stands for International Financial Service Center Authority, which is the regulator, which is Mr. Ashutosh Sharma is CGM over there. So they came out with the Fund Management Regulations 2022 in April 2022, and which laid down the regulatory framework for asset manager, funds, and such like out of business, so which we are dealing with. So the FME, so in short, we are calling it FME regulation, which is Fund Management Entity Regulations. So FME regulations are broadly in three parts. You can, for better understanding, you can put it in three parts. One relates to the fund management entity. When I say fund management entity, in normal words, you can call it an investment manager or an asset manager. We call in India or any globally. So three kind of asset managers or fund management entities are provided under these regulations. And what kind of funds these managers can launch, that is second part, which is called fund and schemes. So we have three category of, like in SEBI India, we call it category 1, 2, 3. Similarly, we have in IFSC GIFT City, we have three category of funds, which is venture capital schemes, restricted schemes, non-retail, and retail schemes. So these three type of funds or schemes can be launched by these kind of asset managers, which are written in orange. Third part, what these regulation talks about are PMS, portfolio management services, investment trusts, family investment funds. So family investment funds again has been a very talk of the town, and lot of HNIs and some billionaires have been. I mean, we have been contacted to set up their funds in FIF in GIFT City. So that this is making news globally within Indians and non-residents, NRIs who are residing outside India. So they are also planning to have their FIF in GIFT City, and I think things will develop further. So this is the broad framework where we are talking about setting up fund in GIFT City. So all these updated regulations are available on the IFSCA website. Those who are interested, they may just Google it out and they'll get the whole regulation out of it. So this is the legal structure. I think the structure, Mr. Rajesh Gandhi would take on the detailed structure and tax aspect of it. But just to give you a general perspective of this, when we say scheme, a fund which is set up in the form of a trust. So who can invest? There are foreign investors, there are Indian investors who can invest in fund by way of contribution. And there is another player, which is FME fund management entity, which operates this fund or make that investment decisions. So, and third is trustee, which acts as a trustee for the funds investor, the contributors. And where this is schemes or the fund can invest, you can see on the down, it can invest in the securities listed in IFSC globally and other AIF. So this is the broad framework, and this is a very standard structure of a fund which is globally present. The same kind of thing are there in GIFT City. So now before moving on forward, in GIFT City, the IFSC regulations are regulating the fund manager. Whereas if you see the Indian regulator like SEBI, which is other than GIFT City, the funds are regulated by SEBI. In GIFT City, the funds are regulated by IFSCA. So the difference one of the main differences, SEBI is regulating the fund, whereas IFSCA is regulating the fund management entity. So it's a basic difference. So that gives more freedom and operational flexibility to the funds in IFSCA. So these are the main documents which are there when you set up a fund, which is a PPM. It is standard. It is in India also, when you set up a Cat 1 or 2, 3, the same things are there as well. So the fund, there is PPM, which is private placement memorandum. This has to be drafted with the objective of the fund. One is the trust deed between the trustee, the trust you make, which is called, when you say what a fund, a fund means the trust. The deed of that particular trust, which describes most of the things, is a trust deed. Then you have a contribution agreement. So as Ashutosh mentioned, that globally LLPs are coming and investing in IFSCA through various funds. So these contribution agreements are the agreements entered between LP and the fund. So these are the agreements which are drafted. And investment management agreement, which is between the fund, which we call a trust, and the fund management entity. So the fund management entity would be charging their expenses and carry and other things. So that is governed by these kind of agreements. So this is the broad set of agreements, which is documentation, which is there in the fund setup system. So when we talk about FME, so there are three category of FME we just saw in the initial slide. So one is authorized FME, which is the basic one. So I'll just run fast because the presentation is long. We'll supply you all these presentations. I'll give you on the main points. So authorized FME is one of the basic one, which would launch funds like which are investing in early stage or angel funds like that, where the minimum net worth of a particular this authorized FME has to be $75,000. In second category of FME, which is non-retail, the minimum net worth is required $500,000. And for a registered FME retail, third category of fund manager, you need a minimum net worth of 1 million. So most of the people, when they approach us to give, we want to set up a fund. So FME, when you are making an FME, first of all, you have to see whether you are matching this net worth criteria or not. So these three fund managers, what kind of funds or schemes they can launch, that is the first category. So we have written the regulations also in which it is provided. If somebody is interested, they can directly go these regulations in the document and the regulations and refer these things. So the first kind of category, they can, the first is venture capital schemes, which is launched by FMEs to invest primarily in startup, early stage ventures like that. And it has to be, it shall have the investors less than 50. Similarly, in restricted scheme, you can have a maximum investor up to 1,000 investors, and for retail, you don't have any particular limitation on the number of investors. So in venture capital, you have includes angel fund. There are angel funds are quite active in GIFT City. Few of them we are already working, and they are investing globally. And foreign angels are investing through those funds in India. So that is quite active in IFSC at the moment. So when we are talking, so just for the ease of understanding, we have just compared all kind of three fund managers. What are the things for them? So it is easy to understand. So what kind of, on the basis of type of schemes which authorized, registered and retail can issue, can launch the funds. When I say scheme means the type of funds they can launch. So its first category can launch venture capital on offered on a private placement basis. Similarly, third can issue restricted schemes, and the last category can do all kind of category funds. So the FME, what kind of FME, what should be the entity? So it can be a company, LLP or a branch. In IFSC you can set up. Second category also you can set up as a company, branch or an LLP. And third category, if you want to do that, but third category, if you would see, LLP is not permitted, only company or branch. So here, the net worth we just spoke, the net worth for these categories are 75K, $500,000 and 1 million. So those who wish to set up an FME in GIFT City, they can do by a branch, and branch of a entity which is regulated in their entity in their jurisdiction. So suppose some Indian wants to set up a FME there, and if they have a entity here which is regulated by a regulator, then you can open it. Otherwise, you cannot set up a branch over there. So if it's a regulated by entity by regulated in your jurisdiction, then you can have a branch. And the best part is that the net worth of your parent company would be considered for the branch also. So that you can see while setting up, because we come across people are unable to match the initial net worth, they struggle around with this. So this can be kept in mind. Recently, I mean, I just take on the recent development of the notification which has come from IFSCA. In February, we had a notification from IFSCA regarding FME net worth. So what it says that net worth has to, the moment you are below the net worth, you cannot launch new funds or schemes, or you cannot accept any new client or activity unless that net worth is restored. So this is the notification of 16 February 2024. So many a times there have been that the net worth goes down. So these are the repercussions as per the clarifications given. So what kind of investors these FME authorized investment managers can use? One is accredited investors. So accredited investors can invest any amount. There is no threshold for them. Other investors, if authorized FME has to use investor other than accredited, then the minimum amount they have to invest is 250K. So this is the minimum amount. For employees and directors, the amount is reduced to $60,000. So here again, there is an update on 25th January 2024. There was a notification for definition of accredited investors, which was not there, is recently notified. So you can Google out, you can get it. So in the end, if time permits, I will talk about, because it talks about what should be the net worth and gross income of an individual who are eligible to be an accredited investors. It goes that way. So it ranges from 1 million to 5 million. So what kind of The main question is, do we need to keep employees in GIFT City? Do we need to have a physical office in GIFT City? What kind of people we need to keep? The answer is yes, you need to have a physical office in GIFT City. You need to have people over there. So like for authorized FME, you at least one principal officer is required for second category 2. And for the third category, you require minimum 3 people over there. I mean, some they can do from little bit of work from home, but they are to be stationed there. They have to be actively working from there. So minimum director requirement is there. For third category, minimum is required 4, as you can see over there. So launch of schemes, when you say launch of a scheme means how do they launch the funds? So for the first category, they can, when they file PPM with the IFSC, they can launch the fund. In second category, they have to file it before 21 working days. And in third category, they have to remove the comments, whatever they get from IFSC, then they can launch with it. So minimum experience. So what kind of experience should be with these kind of authorized FMEs? So for first 2 category, it talks about relevant experience, and for the third category, they have been minimum 5 years of asset under management greater than 200 million with investors of more than 25,000. So these are the criteria which are given for registered FME. So based on what kind of set of client investors you are going to deal with, which geography you are going to invest, you can decide, and what are your net worth or what are your permutation combination on the commercial aspects. Then you can decide what kind of FME you should set up and what kind of fund or scheme you should launch. So what should be the target cost corpus? Means skin in the game. What should be the asset manager is required to invest along with, as you go, you see in AIF in India, asset manager is required to give certain contribution in the fund. Similarly there. So if the target is less than 30 million, so minimum is 2.5% of the target corpus, and maximum is 10% of the target corpus. And if the target corpus is more than 30 million, then you have a different set of commitment which you have to make out. But if you are a angel fund and if you are launching an angel scheme, then the FME contribution has to be 2.5% or $20,000, whichever is less. So for angel scheme or angel fund, it is less. And you can make the contribution can be fulfilled by its associates within 45 days, unlike exempted to maintain by an ongoing basis. So there is a timeline provided where you can complete your contribution. So if you are an angel fund, the FME may get waiver from the investors as per regulation. So certain regulations provide that if it is allowed by a certain majority of the investors, then your contribution may be waived and all those things. So that you can structure and see. So that was about the fund managers. So that was a brief snapshot about the fund managers. So this is about the kind of funds they launch. So one is venture capital scheme, which is by authorized FME. And the second is restricted scheme, non-retail, and third is retail scheme. So these kind of schemes and the funds they can launch. So the legal structure of this particular scheme or the fund is company, LLP or trust. And you see for the rest of the 2 category, company, LLP or trust. And in third category, LLP is not permitted. The most favored and pass-through structure is trust. So majority of the funds are set up in form of trust only. So what is the type of fund? These are, so the first category is close-ended only. They are not open-ended, they are close-ended. The second category can be close-ended and open-ended both. And the third category is also again the both. So corpus, what should be the minimum corpus? So many people would come and ask what minimum corpus we can make, what is the maximum corpus we should keep, and how to go about it. So if you are putting up an authorized FME and if you want to put up a venture capital fund or venture capital scheme, the minimum is 5 million. And if you are putting up a angel fund, then the minimum corpus is $1 million. So similarly, maximum is 200 million. Suppose if you want to set up a fund of more than 200 million corpus, then obviously you have to shift to the next category. So these are the corpuses. So you can decide upon what corpus you are going to make and all those things. So these are the legal things, but on the commercial aspect, too small fund is not commercially viable. So if somebody is thinking to set up a fund, so they should think of a large fund so that commercially and operationally it becomes beneficial for the investment manager. So what kind of number of investors? So maximum investors it should be less than 50 in the first and less than 200 in a portfolio scheme in case of an angel fund. For example, in angel fund, all of you may be knowing that the angel fund would invest deal by deal, and every deal you will have a different set of investors. So now in particular deal, in a particular, whether you are making a VCU or a venture capital undertaking, or you are doing an early stage startup, so in one particular transaction, you would have less than 200 investors. So similarly, you have less than 1,000 for the second category, and third, there is no restriction on this part. So minimum number of investors in a particular, so above was the maximum. What can be the maximum? Minimum, you can see there is no limit. Minimum contribution from an investor in a scheme. So we just talk about if it is an accredited investor, they have no thresholds. But if they are not accredited investors, then in first category they have to invest minimum 250K, and in third category 150K, and it goes like this. And there is a discount, or you can say there is a relaxation for the as a fund manager, employees, partners, and directors. So the tenure, you can see what would be the tenure of these funds. The tenure is minimum is 3 years for the first category. Extension, you can have the extension also of 2 years with the consent of two-thirds of the investors. The second category, which is close-ended, minimum 1 year, and the extension up to 2 years. So it goes like this. And for third scheme, close-ended, minimum 3 year, extension up to 2 years. So these are the tenure of the funds which minimum you can do. But normally you would find for a, let us say, venture capital fund or a Cat 2 fund, second category fund, you would have 7+2 or 6+2, 8+2, that kind of structures available. People would prefer. So investment in unlisted entities. So you can see where they can invest. There is no restriction. On second category, open, if it's an open-ended fund, then maximum 25% of the corpus they can invest in unlisted. And similarly for closed-ended, there is no restriction. So you can see whether for investment in unlisted entity, these are the three differentiation for all these three category of funds. So investment in associates of FME. So if somebody is an associate or FME, whether a fund can, this is general question asked by whether an associate of the, what is an associate of the fund? So there is whether they have certain, the director or the promoters of the FME have certain, there is a certain definition provided in the regulations of the associate. It talks about 20% or more in that particular company or some other engagement with that company. So a specific definition, you can refer it to the, I am running fast just because of paucity of time, because Rajesh ji also is also there. So 25, so investment, so they can invest subject to this. Valuation frequency, so when you are setting up fund, so operational cost, when you see, you have to see what is the operational cost would be. People forget when the operation, you have to do valuation of the companies, you need the valuation to come out. So valuation, you have to do the frequency for first category is yearly. For second category, you have to do half-yearly valuation and open-ended monthly. So these are the costs. So one or two funds I know, they never accounted this cost would be coming. So now they are having this cost on them. So all that has to be considered before you jump into setting up fund. Anywhere, whether in SEBI, it is around nearly the same. So leverage, it is, you can leverage in the first and second category. In third category, it is not permitted. Custodian, obviously it is, if in first category, if the asset under management is greater than 70 million, then the custodian is compulsory in first to same category. And in third category, in any case, it is compulsory, you need to appoint a custodian. So when you appoint a custodian, it is adding up the operational cost. So you can accordingly look at it. So we talk about the fund managers, the three kind of fund managers. We talk about three kind of categories of the funds that can be launched by these three fund managers. And these are the permissible investments by all schemes. All the funds can invest in these kind of things. So you can see unlisted securities in GIFT City, outside money market, debt securities. So all these things are there. So retail scheme, if you say additional condition, retail scheme not permitted to invest in units of mutual funds and AIF in IFSC. So wherever, so what is your object of investing, where you want to invest, you should see whether that particular FME and scheme or the fund is fulfilling your object of investment or not. So these you can refer wherever they can invest. So this is a snapshot how you set up your entity. I mean, that's what we spoke about the regulation on the fund side, but this is the procedural that you apply to GIFT City IFSCA, you get the approval from the IFSCA and SEZ, and after that, there is a procedural that you do your GST registration, you take your IEC code over there, you get the space there, and when you have the registration with SEZ and GIFT City both, then you get the final operation commencement of business letter, and then you can start your business. So now, as Ashutosh ji was telling that now instead of doing what we have done 1.5 years back, we did our registration separately with SEZ and separately with IFSCA. But now the one single window, one single application is being done, and which recently it has been started. So I think which will be beneficial. So this would change. You need not to apply separately to IFSCA and the SEZ Development Commissioner. So both application would go hand in hand. So friends, this was all about as a quick snapshot on the setting up fund in GIFT City. And I thought I ran a little fast because I know the people are eager to hear Rajesh ji, because tax is one of the lifeline of any fund system. So we'll take the question and answer later on. So Rajesh ji, welcome, and we are eagerly waiting to hear your inputs on taxation and structuring of the funds in GIFT City. Rajesh ji, over to you.
Yeah, Samir bhai, thank you. Am I audible?
Yes, you are audible.
Okay, sir. And sorry, is the screen also fully visible?
But we are not able to see you.
Yes, sir. Just trying that also. But in the interest of time, I will see my video. There's some issue, but in the interest of time, if the screen is visible, I would like to start.
Yeah, you can put it on the presentation mode. That would be better.
Okay. This is still not the presentation mode, right?
Yeah, we can. We can move on with this. Yes, you may start, please. Yes.
Right. Okay. Perfect. Thank you. All right. So, sir, how much time do I have? Hard stop at 4 o'clock, or can I go for maybe 5-10 minutes extra? So accordingly, I'll take my time. Should we close at 4, or do you have some extra time? Samir bhai?
Yes, you can take 15 to 20 minutes is fine.
Okay, done.
And thereafter we'll have question answers.
Okay, perfect. All right, good afternoon. As Samir said, and thank you to Ashutosh ji also for laying the background and giving us an update. It is always important to hear from the regulator because so much is happening in the IFSC, the IFSCA as a regulator. That and the good thing is that whenever there's an update, it is always welcome news. It is good news because whatever apprehensions or asks the industry keeps on raising, the regulators have been kind enough to try and make changes to promote business in the IFSC. So it's always great to hear from Ashutosh ji in terms of whatever updates are happening. I will stick myself more on some of the structures which we are seeing with our clients, and also particularly on the tax aspects, because Samir ji has covered the entire FME regulations. So the first structure, as you can see on the screen, is setting up a non-retail fund for inbound, and which will primarily invest in listed securities. And this is the most common structure which we see with our clients who, maybe whether they are Indian fund managers or fund managers based abroad.
राजेश जी, आवाज आपका थोड़ा, your voice is little less, so can you please be louder or
to the mic?
yeah.
Is this better? Is this little better?
Yes.
Yeah. So as I was saying, the first inbound structure, which is setting up a category 3 fund in the GIFT City for investing in the public market, is the most common structure which we have seen with our clients. In this structure, you cannot have any Indian investment because round tripping is not allowed, except for money coming from the fund manager as a sponsor contribution or a related party of the fund manager, which is allowed even though the fund manager may be an Indian person or the group may be Indian. But other than that, as far as the LPs are concerned, all of them need to be non-residents. Now, what is the tax treatment of such a GIFT City fund or AIF, which is designated as a CAT 3 AIF? One is that on any gains from listed investments, the fund will pay tax just like normally we pay on sale of listed securities. So 10% for long term, 15% for short term, to be increased by surcharge and cess. However, the benefit of a GIFT City fund is twofold. One is for dividend and interest income, which is taxed at a flat rate of 10%, no surcharge, nothing, as against 20% under domestic law. And any bonds listed on the IFSC exchange, the rate is about 9%. And a lot of lenders and their fund management teams are nudging the borrowers to get the bonds listed on the IFSC exchange so that they can get the benefit of the 9% rate as against 20% or 40% for any domestic listing. Because as many of you would know, from June 23, the 5% beneficial rate for any borrowings from abroad was withdrawn, and so the rate is now 10 or 20. The lowest rate.
Rajesh ji, can you little zoom in your presentation because participants are not able to read, so can you zoom in the presentation? Yes.
This is better?
Yeah. Now we can see. Yes.
Perfect. Sorry. So as I was saying, against 10 or 20, GIFT City gives the lowest rate of 9% of TDS on interest. And that is where we will see, hopefully in the near future, more and more bonds getting listed on GIFT. The second benefit is that if it is a GIFT City fund which earns any capital gains from non-equity, whether it is debt or bonds, REIT InvITs, mutual funds, derivatives, security receipts, there is no tax in the GIFT City. There is no tax in the GIFT City. So all capital gains from non-equity investments are completely exempt from tax. And this is very much similar to the benefit we will see in Singapore or Mauritius, etc., which give a tax exemption on non-equity. As far as the investor is concerned, he doesn't have to file a return or get a PAN. This is the third benefit of a GIFT City fund as compared to a domestic fund. The investor is completely insulated from Indian compliance or filing requirement, and all the taxes on equity gains or dividend are paid by the GIFT City fund. We'll go to the next one. This is something which is becoming popular now. You might have heard about HDFC setting up a GIFT City mutual fund, and you will hear more. Some of our clients are seriously considering setting up a GIFT City fund to invest in domestic mutual funds. And the reason why this is being done is multifold. One is that you can have 100% NRI participation because the FPI regulations say that if a FPI invests only in mutual funds, then it can have 100% NRIs. So that is one big benefit. So you set up a GIFT City feeder fund, get a FPI license, and then you have 100% NRI participation for investing in mutual funds. The second benefit, as I said in the earlier slide, is that there is tax exemption on capital gains from non-equity investment. So therefore, any gains from sale of mutual funds will be completely exempt from tax in the hands of the GIFT City fund. GIFT City pays no tax. Mutual funds, as you know, are passed through, so they pay no tax. The investor pays no tax. So through and through, there's a complete tax pass through for any foreign investment in mutual funds coming through a GIFT City fund. There is also tax benefit for the fund manager, and I'll speak about that later on in terms of the tax holiday. Again, here, foreign investor does not have to get a PAN or file a return. The third structure which we have seen is investment in debt, whether it is NCDs or stressed assets, etc. So here you would set up a GIFT City fund. The GIFT City fund would invest in ARCs of a domestic securitization trust, and that trust would then invest in loans, etc., purchased to the bank or otherwise. Again, here, what is the tax treatment? The securitization trust, which is in mainland India, is completely passed through, as you know. And when the income is passed on to the GIFT City fund, if it is in the nature of business income, which can be an upside on a stressed investment, that is fully exempt from tax, because for a GIFT City unit, business income is a 10-year holiday. And then if there's any other income, like interest or capital gains, etc., that will be taxed as per normal rates. So there is no benefit on that. And again, your investor will not have to pay any taxes. So that is investment in the stressed assets. The next one is investment in unlisted securities. So for this, you will need to set up a Cat 2 scheme in the GIFT City. And mind you, I think as Samir Bhai told you earlier, there is no categorization in the FME regulation, but the IFSCA gives a categorization for the purpose of tax determination, because as you know, Cat 3 funds get a tax exemption, whereas if it is a Cat 2 fund, as I mentioned in this structure,
तो राजेश
they
जी आपका
don't enjoy-
स्लाइड नहीं मूव कर रहा है शायद स्लाइड आई थिंक
I can see slide 5. I am on slide 5.
okay so no but it is for to us it is slide 2 you can click on slide 5 I think
Can you see this?
no still it is we can see slide 2 only
Okay, if anybody else can confirm, because I can see on the Zoom slide 5.
yeah
So we are still on slide 2.
Okay.
so slide अभी मूव नहीं कर रही है yes हाँ हाँ स्लाइड शो से अब इससे फॉरवर्ड करिए आगे
Okay, perfect. So, as I was telling you, in this case, it will be a Cat 2 fund because it will invest in unlisted securities. And for a Cat 2 fund, there is no particular tax exemption for a GIFT City fund. So, you pay a normal tax 10%, 20%, long term, short term, or dividend will be taxed at 20%, interest 30, 40. So, that is as per a normal rate. And so, therefore, most of the time, why fund managers are still looking at a Cat 2 fund in GIFT City again is two reasons. One is to insulate the investor where he doesn't have to PAN or file a return. And second is on the tax holiday for the fund manager entity, which, as I said, I will discuss later on. Next one is like a fund of funds investment structure, where a GIFT City fund will invest in a domestic fund, which is Cat 1, 2, or 3, and the domestic fund will then invest in the underlying securities. Now, why would you have a fund of fund structure? For two reasons. One is that the fund manager entity will be able to enjoy the tax holiday and the investors will not have to get any PAN or file a return, because if the foreign investors come directly in the domestic AIF, they have to get a PAN, file a return. Whereas if you put them in a GIFT City fund, the investors are insulated. So this is same as setting up, let's say, a Singapore fund or a Mauritius fund to invest in a domestic AIF. And also, if you have a structure where you want to pool money from both domestic Indian investors and foreign investors, then this structure makes sense, where the GIFT City fund collects money from foreign investors, puts the money in the domestic fund, and the domestic fund pools from local and foreign investors both. So you get your bigger AUM in the domestic fund. Now, tax implications broadly remain the same as I described earlier. I don't want to complicate it too much, because it will depend on the category of the domestic AIF, whether it is 1, 2, or 3. 1 and 2 are pass through, 3 is taxable, and it also depends on the category in the GIFT City fund. Again, 1 and 2 are pass through. The GIFT City fund pays tax on behalf of investor, and 3, the GIFT City fund pays its own taxes. So it depends on the combination which you have and the investment profile, but this is the broad structure. The next one, which we are now slowly seeing interest along with family office funds, is an outbound scheme where you set up a GIFT City fund and then pool money either from Indian investors who put money under LRS route, or even from foreign investors, NRIs, etc., who can come in the GIFT City fund and you invest in offshore securities. And again, here, the reason why some of our clients are finding it better is that when they want to invest Indian HNI money abroad, instead of setting up a fund in Ireland or Singapore or Luxembourg, which is extremely costly, and it is also costly to maintain that fund by having a global fund manager distributor or shifting some people from India to the offshore jurisdiction. Having a global fund in the GIFT City makes sense, because you are within India, you can easily move people, and you get the same benefit as an offshore fund. Pretty much the same benefit. So here, since the money belongs to Indian residents, there is no particular tax benefit which the government has given, because ultimately Indian residents are taxed on the global income. So there cannot be a tax arbitrage just because somebody is putting money through a gift fund. So you pay normal tax on dividends and capital gains. Again, here CAT2 will be passed through. So the investor pays tax. If it is a CAT3 fund, then the tax is paid at the fund level, similar to your domestic fund. And as I said earlier, fund manager gets a tax holiday, which otherwise, he would not enjoy if he sets up an Indian AIF to invest abroad. Another problem with the Indian AIF investing abroad is, as you know, there are investment limits, and those limits generally get exhausted. But if you invest through a GIFT City fund, then there are no specific limits, because now you're an offshore fund investing in foreign jurisdiction. Only thing you have to keep in mind is the LRS limit of $250,000 per investor, or the limit for institutional investors if they want to invest in a GIFT City fund. This slide I have already taken earlier in terms of taxation of the GIFT City fund, so I'll not speak about that. This slide, yes, I'll spend a little bit time. This is the taxation of the fund manager entity. So as I was saying, complete tax exemption for 10 out of 15 years. The fund manager entity or any IFSC unit doing any business activity gets a 10-year tax holiday for 100%. Recently, there was an exemption given from TDS also. So any IFSC unit receiving money from an Indian person, there's an exemption given from withholding. So no TDS will be applied, and there's no cash flow issue or need to claim a refund. There is a 9% MAT, but if you set up the IFSC unit as a company which falls in the 22% tax bracket, then even the 9% MAT does not apply. So there is zero tax completely. There can be a dividend tax when the IFSC entity or the fund manager gives a dividend to the, let's say, the owner or the shareholder in Bombay or Delhi, wherever. But then there's a ATM deduction where let's say when the IFSC unit gives a dividend to the parent, when the parent further distributes the dividend, there won't be a double taxation. So there's a 80M benefit. One more relaxation which has been made recently on ease of doing business is that every time the IFSC fund makes a foreign payment, let's say you pay to a foreign distributor or advisor, etc., you don't need to get a CA certificate in 15 CACB. You have a quarterly form which is called 15 CD, which has to be filled on a quarterly basis and filed with CBDT. So that makes it more easier on the compliance side for offshore payments from the IFSC unit. Indirect tax, there is complete exemption. So no GST on procurement of goods, no GST on services provided by IFSC units, customs duty exemption on any procurement of goods by IFSC from abroad, supply of services to foreign customers, as I said, no GST, etc. So full tax pass through on the indirect tax side. That's one. One thing which is sometimes it is important to decide is how do you want the IFSC unit, which is a fund manager, to be set up. It could be set up as a branch, it could be a LLP, or it could be a separate company. Now that depends on how the parent is structured, the tax model at the parent, your position on MAT, etc. But these are the options which are available. Here I've just listed down why you would want to set up a fund in the GIFT City as compared to offshore. So as I said, complete tax pass through on non-equity gains, similar to Mauritius, Singapore, Ireland, etc. 10% tax on dividend and interest, which many of the treaties don't provide you. More importantly, you don't have to satisfy GAR or the treaty principal purpose test. Now, these are very onerous tests which now have to be satisfied. And you might have heard that Mauritius India Treaty has recently introduced this principal purpose test requirement, which basically says that if one of the purpose of your investment through, say, Mauritius or Singapore, wherever, is to plan around tax or tax avoidance, then treaty benefit can be disregarded. Whereas with the GIFT City fund, all these conditions don't apply because you're claiming exemption under Indian domestic law. So therefore, it becomes much more easier to claim treaty or tax benefits. Savings in operating cost, as you all know, Luxembourg is one of the highest costliest jurisdiction, followed by Ireland, Singapore. GIFT City fund comparatively is much more cost effective for both setup and maintenance. Tax benefits I mentioned both for the fund and the fund manager. Yeah, this is my last slide on relocation. So if you have an offshore fund, you have a time limit up to 31st March 2025 to relocate that fund from offshore to a GIFT City, and you get complete pass-through, both from a regulatory point of view and tax point of view, full neutrality on continuing to claim, let's say, losses. There is no tax on the migration to a GIFT City fund. There is no regulatory requirement. You can do a free of cost transfer, etc. So this is something which many of our clients have considered and migrated from, say, a Mauritius to a Singapore into a GIFT City fund. So with that, it is the end of my presentation, and Samir bhai, back to you.
Yeah, thank you, Rajesh bhai. It was excellent. I think every time I last heard you in the event at Delhi, and this time also I am being more informed and educated about the taxation on these funds. So, but there are a lot of questions which we receive every day from the clients. So, Rajesh bhai, you can remove the sharing of their screen. So we'll take up question answers which have come in. Yes. So thank you, Rajesh ji. You have given a very good insight on it, and I know that you are very much, reputed and renowned person in this particular area and very much sought in the professional community. So, but few questions which I have received offline also, and we'll take whatever is asked here also, and we'll keep it short just in the interest of time. First of all, suppose I am a fund manager. I am an FME registered in GIFT City, and I am doing financial services. I am charging certain invoices or money to global clients. I am advising them something or something I'm doing, and that money I am receiving in Gift City. So now that money is, as per what we understand, is totally tax-free for the fund manager in Gift City. You are on mute. I think your voice is not coming. अभी नहीं आया. Yes, please. Now you can. Yeah, please.
Yeah, so I was saying that if it is a gift city fund, you have to set up the management entity for the gift, whether it's a branch or a subsidiary. I think your question is that whether there is full tax exemption for the manager, right?
Yeah. So an FME receiving money for providing financial consulting or services to a global investor, and they are receiving money for him from him in Gift City.
Yeah, absolutely. Please providing management services or advisory services to mutual fund, whether under the FME regulation or under the capital market individual regulation as an advisor. All of that income is exempt from tax for the FME, as long as he's based in the gift city.
Okay, okay. So one thing you mentioned, there is no TDS. For example, a fund or investment manager is paying, let us say fund is distributing the amount to a person resident in India or abroad. So whether the fund is required to deduct TDS on it or not.
TDS, if it is a Cat 2 fund, it will pay tax on behalf of investor. If it is a Cat 3 fund, it will pay its own taxes. There is no TDS as far as the investor is concerned, because investor doesn't have to even obtain a PAN, etc. So taxes will be paid by the fund in its own PAN.
So even for Cat 1 or Cat 2 also?
Yeah, yeah. The only question is that can the investor claim a credit for that tax in his home jurisdiction? And that depends from country to country. For example, if it is a US investor, then normally the Gift City Fund will issue a form called as K1 form to the investor, based on which he is able to claim a credit for the Indian tax paid by the Gift City Fund in his home country in the US.
Okay. And what is the status of the fund manager when he is getting carry from the fund?
So again, that depends on how the carry is structured. If it is in the form of performance fee, then it will be exempt as business income. If it is in the form of a redemption of units, then it will be exempt as capital gains, because the Gift City FME is earning capital gains from a Gift City fund. So either way, it should be exempt.
Okay. So what is the case when a Gift City fund is investing in Indian company? Gift City fund investing in Indian company, and when in that case, what is the treatment when he exits or he sells the shares, let us say to some foreigner or somebody?
The same, because the tax treatment for the manager or FME does not depend on where the Gift City is investing, whether the Gift City invests in Indian securities or it invests in foreign securities. The manager is getting his return from a Gift City fund, and therefore that income is exempt for the manager.
Okay, okay, okay. So one thing we all listen, we have heard about it, like the concept of poem, whether it is applicable here. What are your views on it? So people ask this most of the times.
Yeah, again, question. So poem, yes, is still important because, and many times we are getting questions now saying that I don't want to set up a fund in the GIFT City. I just want to manage offshore money sitting in the GIFT as a FME.
Hmm.
So in that case, from a tax point of view, GIFT City is still considered as part of India. So if you are manager in GIFT managing foreign money, then there is still a poem issue for the fund, and therefore you should obtain 9A approval, which is 9A, section 9A of the income tax law. Obtain approval from CBDT to ensure that there is no poem or PE risk for the offshore fund.
So this is in case of if they are managing the offshore fund outside India.
Yeah.
But when they are managing within a GIFT City fund, so that does not apply there. Okay. Okay. So I think we are nearing our time, and we have answered a lot of questions which have come to you. So just I would like you to enlighten the audience what kind of your experience have been so far, how kind of whether the work has increased for the like clients approaching for GIFT City. What is your at the moment, how you are keeping busy on GIFT City related matters? How much are you seeing any increasing influx on GIFT City related matters?
Every week we see proposals or new applications going for a GIFT City fund. Largely they are Cat 3, but we are also seeing a lot of interest in Cat 2 funds, investing in private equity funds, investing in startups or the tech sector, or whatever it is, medical tech, whether it is fintech, whatever. So that also interest we are seeing. As I said, mutual funds, we are seeing slowly interest where some of our domestic mutual funds clients wants to set up GIFT City fund, but that won't become a big mass because there'll be very few mutual funds who will set up a GIFT City fund. But the Cat 3 listed is where we see a lot of interest. Outbound, we have seen some interest in investing abroad. FIF or the Family Investment Fund, we see a lot of our family office clients waiting for clarification. As you would have heard in the papers, Azim Premji Trust has got approval from GIFT City authorities, but we are still waiting for RBI clarification on whether it is a OPI or a ODI investment. And once that comes in, there will be a big flow of applications being made by family offices to set up a GIFT City fund to invest abroad. Obviously, government is very careful here to ensure that there is no significant flight of capital. So a balancing act is what they are trying to do. But that is one thing which is waiting to explode in GIFT. Yeah, that is where we are as far as the fund industry is concerned.
Okay. So thank you, Rajesh ji. I think we are at the conclusion of our webinar, and I thank you very much for sparing your time. And I know you are quite busy and you are attending so many matters. So thank you once again. And if you can ask some of you, because we have received a lot of requests, people are requesting for your presentation, and if it is possible, you can share. So we can circulate to the participants.
And thank you for this opportunity and a chance to speak to all your participants. Thank you.
Thank you. Thank you. Thank you, Ananya. Thank you. Over to you. Thank you very much.
Thank you so much, Rajesh sir. Thank you so much, Ashutosh sir, and thank you so much, Sameer sir. I also want to thank all the participants who joined today's seminar. Thank you everyone for your precious time, and I'm sure all the inputs and deliberations have resolved the practical issues that people are facing in the newly set up GIFT City. And it was really enlightening. Thank you so much.
Thank you very much. Thank you, Rajesh.
Thank you.
Thank you. Thank you. As India Juris, we aim to be the best place for the lawyers to work in and set up standards for the lawyers to develop their skills being in this law firm. We aim to provide high standard of international legal services to our international, global and domestic clients.
India Juris is having innovative strategies with regard to intellectual property rights disputes as well as international dispute resolution. And we are having a lot of milestones which we have achieved and about to achieve.
At India Juris, as a full-fledged law firm, we are advising corporates, startups for their advice on IPOs and further transactional matters.
As India Juris, we aim to be the best place for the lawyers to work in and set up standards for the lawyers to develop their skills being in this law firm. We aim to provide high standard of international legal services to our international, global and domestic clients.
India Juris is having innovative strategies with regard to intellectual property rights disputes as well as international dispute resolution. And we are having a lot of milestones which we have achieved and about to achieve.
At India Juris, as a full-fledged law firm, we are advising corporates, startups for their advice on IPOs and further transactional matters.